everyone. We'll wait for another 3-4 minutes before we start the session. Start, Senthil?
Yes, yeah.
Okay, great. Hi, good morning, everyone, and a warm welcome to today's webinar on navigating market cycles with Solitaire. We are really excited to walk you through our thought process, how we manage risk, and the principles that make Solitaire what it is today. I hope this session gives you useful insights into how we think about investing, especially during times of volatility. Right? So let me walk you through what really defines Solitaire. These 4 pillars you see on the slide, they're not just bullet points. They're principles that shape how we think, how we invest, and how we protect and grow your capital. Our investment approach is fundamentally long-term in nature. We believe that wealth is not created by jumping in and out of the market. It's created by owning quality businesses and holding them through cycles. And that requires patience, discipline, and above all, conviction in what we own. We at Solitaire follow a buy and hold strategy. Allowing investments the time they need to compound. We are not in a race to outperform every quarter. We are here to build portfolios that deliver sustainable, superior returns over time. So this approach has also helped our investors navigate some very volatile phases, from COVID to inflation shocks to various wars, because they weren't constantly reacting, but staying invested in fundamentally strong businesses. Right? So that defines a long-term focus. Now, second point is non-consensus investing. So we try to avoid following the crowd, because consensus investing often leads to crowded trades and poor risk reward. Instead, we look for opportunities where others aren't. Underappreciated businesses, out of favor sectors, or stories that the market has not fully discovered yet. Focus on finding value where it's not obvious. That's how we have consistently added some unique stocks to our portfolios. And we generally do not buy banks or NBFCs in our portfolios. So this approach takes courage, does take courage. It's not easy to buy and what others are ignoring. But it also leads to better entry prices, lower downside risk, and better long-term upside. We are bottom-up investors. That means our starting point is always the business, not the index, not the economy, and not the overall market sentiment also, right? We try to ask some very simple but powerful questions, like, does this company have a good track record of capital efficiency? Are the promoters aligned with minority shareholders? Is there a good culture of corporate governance? Is the business model viable? Some very basic questions, right? And then we dive deep into annual reports, management commentary, ownership patterns, capital allocation history. We want to understand how the business behaves, not just when times are good, but also when they have been challenging for the company, right? So this is the kind of groundwork that helps us build the conviction. But once we invest, we stay with these companies for a few years, and we try to do so with a lot of clarity and confidence and not hope, right? And the last point is very, very high focus on risk management. Now, sometimes risk is often misunderstood. Risk is not just about volatility. It's about how much you could lose when things go wrong, right? At Solitaire, we manage risk not just through diversification, but through the kind of companies we own. So we consciously avoid companies with excessive debt, governance issues, promoters who lack skin in the game, or some businesses which are dependent on fads or hype. And as I said, we avoid banking and NBFCs, right? So we try to build portfolios with market leaders, companies with strong balance sheets and predictable cash flows, right? These businesses don't collapse when the tide turns. In fact, many emerge stronger from downturns. So our risk management framework also involves position sizing. We rarely go over 7% allocation in any one stock at cost. We scale into positions gradually, keeping room to average down if the valuations were to improve, right? And when an investment goes wrong, we also have clear exit rules in place. We are not emotionally attached. We trim or exit based on fundamentals and thresholds we have set internally, and not on headlines or panic. Right? So these four pillars, long-term thinking, independent ideas, business first lens, and a deep risk control. These are the very core of how we manage money in Solitaire. But underneath all of this is something very important. I mean, even more important, these 4 points is adaptability. So investment success isn't about finding a rigid formula that has worked again and again. I think it's about evolving with time, markets, and investors' needs. We also believe in educating and supporting our investors, helping them stay invested during down cycles. encouraging top-ups at the right times, and building confidence in the strategy. Because in the end, investing isn't just financial, it's also deeply psychological. It's about trusting a process that's thoughtful, tested, and aligned with your long-term success. Moving on to the USP of Solitaire. You've seen the foundation of how we think. Let me quickly try to take you through what makes Solitaire different in practice also. Customized portfolios. So at Solitaire, we do not follow a model portfolio approach. We try to build portfolios thoughtfully and gradually over a period of time. We may start similarly for two portfolios starting in the same time, but over time, your portfolio evolves uniquely. It's shaped not just by your investment or our investment calls, but by your level of participation, how and when you respond, how you deploy additional capital during opportunities, and your overall discipline in the process will shape your portfolio. For example, if two investors begin at the same time, but one adds to their portfolio whenever we call for it, especially during market dips, the portfolio outcome can be significantly different over the years. And that journey becomes truly differentiated, not just in what you hold, but in how well it performs, because of how actively you participate along the way. So the investment behavior plays a very, very important role in customizing or differentiating your portfolio from the rest. This level of partnership is what makes Solitaire stand apart. Investing into businesses of the future. So this means that we are constantly looking for businesses that are innovating, scaling, or operating in sectors aligned with long-term structural trends, whether that's formalization, consumption, digitization, or any newer trends that are visible. But one important point, or the key, we still apply our bottom-up lens. We still apply our bottom-up approach. Just because a business is in a hot space doesn't mean we will buy it. It has to still meet our filters: strong governance, low debt, high ROC, and also fair valuations. Right? Now let's talk of how we buy. So we don't believe in staying fully invested just for the sake of it. Right? We deploy capital gradually, strategically, and most importantly, opportunistically. Right? We wait for the right valuations. When markets correct, or when a great business is temporarily going through a tough period or ignored, that's when we step in. This is where experience really matters. Understanding market psychology, staying calm during volatility, and acting when others hesitate. That's how we have been able to add quality names at compelling prices time and again. So we encourage the same from our investors to stay ready to top up their portfolios during market correction, because that's when you lay the foundation for long-term outperformance. The last point is low churn. So we try to follow a buy and hold approach. Once we buy into a company, after months of research and analysis, we give it time. We allow the story to play out. We stay invested through cycles. We monitor performance and let compounding do its job. So this buy and hold mindset reduces transaction costs and also gives you a much more stable investment experience. It also helps us avoid the behavioral traps that most investors fall into, like chasing performance, switching frequently, and sometimes reacting to noise or getting panic. Right? So in summary, trying to create or differentiate portfolios over a period of time, focus on future-ready businesses, opportunistic yet disciplined entry, and a buy and hold approach. That's the Solitaire way. And this isn't just theory. All our portfolios reflect this same approach. Now, moving on to the next slide. So what exactly makes a great investment. So great investment happens when strong fundamentals meet attractive valuations. It sounds simple, but it takes immense discipline and patience to consistently apply this formula. So let's break it down. At Solitaire, we are focused on fundamentals because no amount of market optimism can save a weak business, right? So what do we mean by fundamentals? So we are looking for businesses, that have experienced leadership, preferably with a track record of sound decision making, capital allocation, and execution. Good corporate governance, where promoters and management meets and respects shareholders, communicate, and are at least transparent in their communication and are acting responsibly. Industry leadership. We love businesses that are either one or two, number one or number two in their segment, right? They generally tend to have better pricing power, also better distribution strength, and margin stability. High ROC, return on capital employed. This tells us how efficiently the business turns capitals into profits. It's a very important metric for us, right? And low or zero debt, especially important during downturns. Debt-free businesses tend to weather storms better, which means less downside for us, right? Now, even the best business becomes a risky investment if you overpay. And that's why the last point, valuation, is the second half of the equation. And this is where patience plays a very huge role, right? Sometimes we track businesses for months, sometimes years, right? And wait for valuation resets, market corrections, or some specific events that brings prices to a level where the risk and reward makes sense to us to buy into the portfolio, right? Buying great businesses is not hard, but buying them at the right price, I think that's where value is created, and that's what Solitaire is trying to deliver. This is also where we encourage investors to participate actively. When valuations are in our favor, and we call for additional capital, and investors participate and end up holding these quality businesses at optimal prices, I think that is what directly impacts long-term performance. But why this matters? I think when both these conditions come together, right, a solid business and a fair or discounted valuation, we act. I think that's our sweet spot. The downside is protected because the valuation gives us a margin of safety, and the upside plays out over time as the market eventually recognizes the value. I think that's how compounding works best, when you enter right and let quality do its work. This is also what helps us stay calm in volatile phases, because when you know what you own fundamentally is a sound business, and you have bought at reasonable prices, you don't worry about short-term noise. You stay invested and you are focused on the bigger picture. Great investments are found by doing the hard work, analyzing businesses, knowing what to avoid, having the conviction to wait, and sometimes the courage to act. I think that's what we do at Solitaire, so that you as an investor can enjoy a low stress and high conviction investment journey. I'll just ask my colleague Senthil to come in and take us through some of the portfolio related points.
Thanks, Gaurav. And, good morning to all. So in the first part, you might have seen what's the philosophy on which Solitaire as a portfolio has been constructed. So in the subsequent slides, you will see the current positioning of Solitaire and how the philosophy of Solitaire has been executed in terms of you can see various metrics you will see in terms of that will support the case, how the entire philosophy that goes into construction has panned out over the last 5.5 years. So the first is in terms of what's the process that goes into selection of stocks. So if you see in India, we have like more than 5,000 odd stocks being in the listed space. And so within those 5,000 odd stocks, uh, we should have a sense of various metrics that goes into selecting companies that will give compounding returns. So it's not that if you see, I think majority of the stocks will be like cyclical in nature, and those stocks cannot be held over a long period of time because even for a 2 years or a 3 year period, because the businesses which they are into or the kind of size of the business will be much more prone to economic cyclicality and things like that. So on the backdrop of that, what we generally do is that within any sector, basically we drill down to at least 10 to 12 companies based on what has been their business track record, how the management has performed in the past, and more particularly how the minority shareholders have been treated in the company. Uh, because being a minority shareholder, we don't have a say in terms of how the business strategy is being executed and things like that. So we are very conscious in terms of how the management views a minority shareholder. So based on all these aspects, uh, 10 to 12 companies from any sector has been chosen. And within these 10 to 12 companies, we further drill down in terms of their business strength, because and how the management strategy has panned out, because these two things enable the company to scale up their business. We have seen, I think, if you are in markets for last 10, 12 years or 20 years, you might have seen many businesses face this issue of being scaling up. They could have listed in like 500 crore or sales, but over the last 10, 12 years, if you see their sales growth won't be like even catching up the real GDP. But on the other hand, if you would have seen only a handful of businesses over a 10-year period, 20-year period, they could have outgrown the nominal GDP and they could have scaled up at the global level. So the second level of filtering is that whether these businesses has the potential to be scaled up, or they have they already witnessed scaling up. So this is what the second process of filtering. So this is like 2 3 companies we have we could have at this point of juncture. And so post this, so these 2 3 companies are well positioned to be in the portfolio. But to be in the portfolio, right, I think one key parameter and the last major parameter is the valuation. We have seen in the last 2 years also, we are seeing the good quality companies, great businesses, hasn't been great performance in terms of stock price. That majorly because the entry valuations was quite high. So entry valuations not only factored the earnings growth for the next 3 years, but it was overvalued in terms of what the business can deliver. In Solitaire, we are very much conscious of how the valuation, the entry valuation is the stock that is coming into the portfolio. Based on these three process of selection, the universe will have like 10 12 companies. So out of the 5,000 odd listed companies in Solitaire, we have a universe which has like 400 odd companies. So from these 400 odd companies, the pipeline will be like around 30 to 40 companies. And how this pipeline helps is that constantly tracking these pipeline stocks quarter over quarter in terms of how the management strategy is panning out and things like that. Either because of any macro volatility or any business cyclicality, which is suddenly the sentiment in these stocks can change at a very short period of time. So by having worked on these stocks and having tracked this for over a period of time, so the investment team is much more nimble in terms of taking the decisions and then buying at the right point of time. So that's how this entire process helps in buying the stock at a correct point of time and having conviction built up over the last 2 years, 3 years in terms of having those stocks in the pipeline. So second slide is a continuation of that. So having seen how the idea has been generated, so the execution also, it's very important. As Gaurav mentioned earlier, so the portfolios are extremely customized for the investors, and it depends upon what time you are getting into the portfolio. And so the execution happens at various points of time. It's so buying is just one part of the execution, and then we also constantly monitor it, how the valuation pans out, whether there is a change in business strategy, and everything is being tracked. And if we find that there is any change, and the further process also happens. And the last one is maintenance. So we have seen in many companies in Solitaire, they continue to perform as expected over the years, and our churn ratio has been one of the lowest, like at most around 10% or 10 to 12% is our churn ratio. So maintenance is a very core part. So in that, all the analysts in the investment team, they track the companies, just that they don't uh, go out of what is being expected out of them. So that's where the conviction gets built up slowly also. Sometimes when a new stocks comes in, the maintenance research in terms of quarterly attending AGMs and things like that, that helps in building conviction over a period of time, and maintaining the investment process at a stable level. So having seen how the process of stock selection, how the portfolio is maintained, we will get into how the current portfolio looks like in terms of various metrics. First, one of the key things is that all these metrics are as an end result of the investment process that is being followed. So if you see, currently we have close to around 43 odd stocks in the portfolio. Um, Almost, if you see, 28 of them are leadership in their own businesses. So either they are like number one in their businesses, either in domestically or globally. So that shows that why having market leaders in the portfolio, right? So the current macro situation, as all of you know, that with the US tariffs and the entire global trade being very volatile, being a market leader gives you flexibility in terms of how to approach the business, in terms of approaching clients. So if you're a market leader, you will be in a better position to assess the number three or number four player in terms of speaking with the clients, in terms of how you make your business be more stable in terms of volatile times. So almost 28 of Solitaire companies are either number one in their business, and if you see 10 companies are in the number two position. So almost 38 companies out of 43, like 90% of the stocks are number one or number two in their business. So this gives stability to the portfolio in volatile times. So next, adding to that, we also focus on companies uh, which are like good low leverage in terms of balance sheet hygiene. So if you see, compared to BSE 500, which is a benchmark for the Solitaire, so the number of companies in Solitaire with debt is just 20%. Yeah, there may be many questions that having debt at optimal level is good, but yes, because that helps in giving a better ROE. But having a low debt or a no debt helps in volatile times, because the companies we have seen in the past also, uh, was during these stress times only, the companies get more opportunities to in terms of inorganic opportunities. The smaller players will be in stress, and these companies being market leaders and having the balance sheet strength, they will get an opportunity during these volatile times to acquire these small companies. So this not only already the organic growth of these companies will be higher than the nominal GDP. Further, this adds to this organic growth. So that's where you can get the extra growth lever, and these companies outgrow the other industry growth. Uh, yeah. So moving to the next slide. Uh, So we have seen balance sheet hygiene, and the next important thing is that how the portfolio is classified in terms of market cap. So this is also one of the interesting data points. And if you see, large cap is almost 30% of the portfolio, and if you see mid and small, it's almost another 70%. And so this classification is based on AMFIs and what SEBI maintains on a 6-month basis. They comes out with their own classification in terms of, suppose if the market cap is above a threshold, it will be classified as large cap. So currently, if you see, anything below 33,000 crores is being classified as small cap. So small cap doesn't mean that they are like 500 crore company or 1,000 crore company. Anything below 33,000 crores has been classified as small cap. So many of the investors see that we have like more than 50% allocation to small cap. Why? But we have to see the SEBI classification. Even if a company is 30,000 crores, then it's a small cap. So Solitaire, we have a strict criteria in terms of filtering companies which have at least more than 1,000 crores of market cap. So we generally don't go below 1,000 crores, but yeah. So we are broadly classified in terms of market cap, and uh, one of the main end result is portfolio beta. So if you see a portfolio beta versus the BSE 500 index, it's 0.76. So it shows that how the portfolio moves versus the index. And uh, another main point is that MNC companies. So we have seen almost 90% of the portfolio is market leaders. And if you see out of that entire portfolio, 20%, like 9 companies, are MNC companies. So why MNCs? If you see generally MNCs in terms of management quality, because they will be mostly professional in nature, and they will be global in nature. So either in terms of adopting to new technology, suppose for example, we have seen that last 2-3 years, a lot of sectors are undergoing disruption in terms of technology. Like for example, auto, you are seeing the entire powertrain is getting changed from ICE to EVs. So if the company is an MNC, automatically the technology is being get from the parent. So the company can compete effectively in the domestic market, and we have a clear case or high probability that the company will maintain its leadership when the industry transition to a new technology also. So this is a couple of things to on the portfolio structure, and coming to the sector allocation. Um, so even here, how Solitaire is constructed is that we have a balanced sector allocation, and as Gaurav mentioned earlier, we don't have allocation to banks. So banks are generally levered businesses. Uh, so as Solitaire is more constructed towards a long-term oriented compounding thing, uh, we generally eliminated the banks being a levered businesses. Suppose that I think if you see, uh, and the sector allocation is not a very constant thing. If you have been with us for the last 5 years, you will notice that how the sector has been changing. So from an export-oriented kind of sectors in the 2 years back, now the Solitaire has been moved to a domestic-oriented weightage. That's because all this being a macro. So basically bottom up in terms of stock selection, but also we have to be top down in terms of from the balance sector allocation level. So we see the highest allocation to Solitaire is currently now like FMCG, and then we have auto, then we have capital goods. If you would have noticed, we have steadily brought down the weights on capital goods. So even though we don't have any allocation to banks, but if we see we have allocation to other financial entities. So we have a fair bit of allocation to the life insurance companies, general insurance companies, and the asset management companies. So financial services, we are like almost 14 to 15% weight in the Solitaire. So that's how the portfolio's current sector allocation looks like. And so this is one of the important slides, right? Because out of those almost 43 stocks, if you see, 32 stocks weightage is in the 0 to 3 position. So this is one of the main reasons why you see beta is less 0.75 times the index, and also during volatile times, this gives conviction in terms of holding on or adding to the portfolio, because we have just one stock in the 5 to 7% weightage, and nine stocks in the 3 to 5%. So if you see majority of the portfolio in the 0 to 3% weightage, even if one or two businesses are facing increased volatility due to macro situation and things like that, the portfolio construction will be much more stable. So moving on to what Gaurav also mentioned in the earlier is the non-consensus investing. So this is Solitaire portfolio versus the flexi cap mutual funds. So here you can see that almost the Solitaire portfolio is like 80 to 90% away from these flexi cap mutual funds. So this shows that how the portfolio, how the non-consistent investing has been followed vigorously in construction. And this is the top 10 flexi cap mutual funds. So even if you see is Parak Parek, so the only the 25% of the portfolio is common between Solitaire and Parak Parek, but almost 70% is away. So just to an example for a valuation and growth, this is one of the stocks which we had in Solitaire, and so the entire the point of sharing this thing is that the initial entry point, as we mentioned, we always maintain that we buy it at a very reasonable valuation, and then as the business performs, we accumulate it over a period of time. And so whenever the valuation is above our range, either in terms of so how we arrive at company whether valuation is over our range is that we look at the next 3 years earnings potential of the stock, and see over the next three years at least the company can make around 13 to 15% kind of CAGR. If that is not happening, then obviously we take a call in terms of pruning the stock. So that's how the entire right from the generation and then execution, and then we maintain the stock over a period of time, and then obviously the stock selling happens. Yeah. Yes. So now I just over to Gaurav to take on for the further slides.
Thank you, Senthil, for those points. Now, let's talk about something that's often overlooked. Your behavior as an investor. So people often assume investing success depends on intelligence. But in our experience, it's the right habits and consistency that makes the biggest difference. We have seen that successful investors tend to show two key traits: conviction in their choices and the patience to let their investments grow. So what works well? I think making regular investments, no matter what the market is doing, and adding more when opportunities come up. And what leads to poor results? I think trying to time the market or waiting for the perfect time, procrastinating, or letting emotions take over, like fear during corrections or greed during bull rallies. Right? Remember, markets are dynamic. New opportunities will come and go. So being engaged and responsive is going to matter. And so does staying calm and consistent. The goal is not to just invest, but to build a system of behavior that supports your investment goals in the long run. So yeah, try not to time it and maintain your emotional discipline. Next slide, please. So let's take a moment here to understand what one can realistically expect from the portfolio to look like over time. Right? So we often think about investing in terms of instant returns. I think, but real investing doesn't work like that. It takes time, just like our plant takes time to grow. In a well-built portfolio, the outcome typically shapes up the following manner. I think And that's how it has been for Solitaire also. I think you'll have a few big winners, companies that do extremely well and create significant wealth. I think these are the ones where compounding really plays out. Then you will have a good number of steady performers. They may not become headliners, but they'll quietly deliver returns and grow over time. And yes, you will obviously have a few that don't do well. I think that's normal. What matters is how we manage them. If we see the fundamentals of a company are weakening, we exit. We don't hold on for any emotional reasons, right? I think the important thing is to stay patient, regularly review performance, and stick to the process. Over time, the portfolio becomes stronger because of this discipline that is there in the portfolio construction. Next one. At Solitaire, as we have been discussing a little bit in the past, that we have a high focus on risk management. So we operate with a moderate risk approach. I think right in the middle between conservative and aggressive. I think we believe this is a good zone for long-term wealth creation without taking undue risks. Our return expectation is somewhere between inflation plus 700 to 900 basis points, or roughly 7-8% over inflation. Obviously, depending on market conditions. The portfolio, an individual client portfolio will typically hold close to 30 stocks. And as I said earlier, and Senthil also pointed out, that we cap our exposure to any single stock at 7% at cost. And you saw the data that we have most of our holdings between 0 to 3%. So I think 3% is what our sweet spot is. And we try to build positions beyond that only when we are extremely convinced and the valuations are extremely attractive for us. Right? As we discussed earlier, we avoid companies with high debt or weak fundamentals. And we usually don't invest in banks, PSUs, or NBFCs. I think because they carry higher policy-related risk also, and because of their levered nature, right? But what makes us different is how we manage risk. As you saw, the beta of the portfolio is 0.75, is extremely lower than the benchmark, right? So we try to focus on controllable risk. That is, like, we choose companies with good leadership, low leverage, and sound decision-making history. But at the same time, we are also aware of few of the uncontrollable risks, like global events, which is happening right now as we speak, right? So we try to keep the portfolio resilient and diversified to adapt to such times or such events, which are not in our control. Over time, what happens, this helps the portfolio handle uncertainty better and also positions it to benefit when things turn around. I think that's the essence of our risk management strategy. Yes. The next slide. Yeah. So these two slides which you saw, right, is about helping us to set expectations calmly and realistically. What you see here is a long-term view of the Nifty's returns across different time periods. I think each row is a starting year, and the columns show how returns panned out over the next few years from that point. What stand out is clearly that short-term returns can be very unpredictable, as you can see. But as you go further out, like 5, 10, 15 years, I think the variation is smoothing out. The variation smoothens. Most numbers fall into a stable range. This tells us two things. First, time in the market matters more than timing the market. And secondly, consistency pays off. I think that's why we have gone back so many times to this quote: long-term consistency trumps short-term intensity. So as I said, right, we are trying to deliver returns of 700 to 900 bips above inflation, right? And by staying in the moderate risk zone, not being overly aggressive, but at the same time also not too conservative. So this clarity in return expectation combined with realistic timelines and thoughtful risk management, I think is what helps our investors stay the course with confidence. Next slide. So I will just quickly talk about what our positioning is on Solitaire today, right? As Solitaire is entering in its 6th year as a portfolio strategy, and right from the beginning, it's been built with a clear purpose to deliver superior long-term returns while keeping risk at a moderate level. We follow a bottom-up approach, as we discussed, which means we are focusing on understanding individual businesses deeply before investing. Solitaire is a structured flexi-cap strategy, which gives us the freedom to move across large, mid, and small cap spaces, depending on where the best opportunities lie. Our preferred holding period is generally between 3 to 5 years or maybe more. If the potential continues to exist, we are happy to hold on good businesses for much longer time zones. Right? We don't exit just because the market is uncertain or because something hasn't moved yet. We exit only when the reason we invested in the first place no longer holds. Right? The way we build portfolio is gradual and deliberate. We are not chasing trends or we are not reacting to noise. We constantly reassess where we are invested, and when a stock has done well and valuations have become expensive, we do trim also in our portfolios. When we see new opportunities with strong future potential, we allocate. So while the portfolio remains rooted in quality, the composition keeps evolving as the market environment changes. As Senthil showed, right? 2 years back, we were very heavy on capital goods, and now you see us getting heavier a little bit on the consumption side, right? So this evolution will keep happening as the market environment changes. Right now, for instance, the market is going through a very volatile phase, and while that may create anxiety for many, we are looking at it as a chance to strengthen the portfolio further. I think the best opportunities often show up when the broader sentiment is negative, and that's what we are experiencing right now. So for a new investor, participating during such phases can make a meaningful difference to long-term outcomes. Solitaire also focuses mostly on companies that benefit from India's domestic growth story. As Senthil was saying, that we have a very domestic heavy oriented portfolio right now. We are not heavily reliant on global demand or exports. And with the Indian economy expected to grow steadily, we believe that any temporary dips in the market will eventually get offset by strong underlying fundamentals. And this is exactly where our positioning comes in. Solitaire is consciously structured to avoid the most fragile areas of the market. We stay away from over-leveraged businesses and a few sectors like banks, NBFCs, which carry high financial risk, right? So that makes the portfolio a little bit more stable and also better prepared to handle tough phases. Another thing that makes Solitaire truly different is our contrarian mindset, which we discussed earlier, right? We don't believe that taking more risk guarantees better returns. We believe in taking smart, well-researched positions. We are conscious when others are excited, and we become more active. We are cautious when others are excited, and we become more active when others are fearful. So this helps us stay balanced through market cycles. More importantly, I think this approach helps us stay focused and invested without any panic or second guessing our investment choices, and also gives your money the time it needs to grow. Similarly, when markets are weak, we are always looking out for opportunities. When valuations are attractive, we increase exposure, and when they look expensive, we cut back. So this discipline helps reduce risk on the downside and positions the portfolio to benefit when markets recover. I think one of the most effective ways to create long-term wealth is to invest regularly, especially during periods like this, when the broader market feels uncertain. And along the way, we continue to identify specific high conviction opportunities, which are rare but important chances to invest in businesses that can meaningfully give a boost to your long-term returns. I think these are the kind of moments we will always encourage you to take part in. So Solitaire is not just a product, it's a thoughtfully managed strategy backed by research, discipline, and alignment to your long-term goals. Our goal is to help you stay consistent, avoid unnecessary risk, and participate in India's long-term growth with confidence. Keep contributing, keep participating. I think that's a simple and proven path to long-term wealth. Yeah. So this is just some of the key terms. Minimum investment and PMS is 50 lakhs as per SEBI regulation. Benchmark is BSE 500 TRI. Exit load is 3% for the first year, 2% for the second, and 1% for the third year. After that, there is no exit load. Fee is 1.5% per annum, computed on daily weighted average portfolio, but charged on a quarterly basis. And there are a few other expenses like fund accounting, custodian charges, which are charged at actuals. All these are excluding GST. And another point on the risk management, we do not exceed a single sector by 55%, and single stock exposure doesn't go beyond 25%. It's a long only fund which invests only in equity, so you not see commodities or any other kind of assets being part of this portfolio. It's a long only equity portfolio. In the performance since inception, we have done close to 21.93 post fees. Benchmark has done close to 18%, 18.17%. And we started the portfolio in August 2019. As of March end, the cash levels in the portfolio were close to 2%. And all this data are disclosed every month on the SEBI's website. You can move and check a lot more information about the product on SEBI's website and also on our website. This is the team. Shyam Shekhar is the fund manager, and then we have a very solid research and strategy team who are consistently working towards identifying newer opportunities and maintaining and managing the risks in the portfolio. So thank you so much for listening patiently. And if Senthil is also okay, we are ready to take few questions. You can put your questions on the chat box, and then we'll try to answer as much as possible. We generally try to avoid any stock-specific questions due to compliance issues, but whatever we can answer, we'll try to answer. Yeah, sure. I think we'll be able to share the recording, Dinesh. It's not a problem. I'll ask someone from my team to do that for you. I think there's a question on chemical sector. When do you think the chemical sector will revive from the current downtrend? So I think basically we don't have any chemical play as such in our portfolio. I'll try to answer with as much information I have. I think chemical sector globally has been going through a weak phase because of few reasons. High material cost and the demand from China has been sluggish, and there have been inventory corrections across industries. However, maybe we are almost we are the bottom of the down cycle, and over the next 3 to 5 years, you maybe 2 to 5 years, you may see some gradual improvement, right? And the factors that will drive that revival, China's slowdown should stabilize, and global supply chains should start normalizing, which will support volume growth. And secondly, many Indian chemical companies, because of their cost advantage and quality standards, especially with global customers looking to diversify away from China. Pricing power may not come back immediately, but I think volumes have to pick up first, and profitability, I think, will follow gradually. So we see the next few quarters and see how this phase plays out for this sector, and maybe a steady revival thereafter. So I think we have to keep a very close watch on how this plays out. Is at present Salt is underperforming compared to Nifty 500. I would suggest that you look at the returns comparison over a 3 to 5 year period, and not for a 6 month or a 1 year period, because our construction strategy, portfolio construction strategy itself is slightly different. I'm not deploying the money on day one whenever a portfolio starts. I take a few months to deploy the portfolio as and when opportunity starts. It's very gradual and deliberate, as I told earlier. So anything less than 3 to 4 years, I would suggest that let's not look at the returns for that time period. Beyond 3 4 years, I think it makes sense to have a very reasonable comparison with benchmark and other products, flexicap products, right? Because the portfolio is getting constructed for, let's say, the first 12 to 18 months, and then the delivery performance of those businesses comes in the next 2 to 3 years. That is where the right comparison will be. So short-term comparison I will avoid, and I would suggest generally try avoiding any kind of comparison. You should focus on your goals and what are your return expectations from the product. And if that is being delivered, I think you can stay consistently being invested with the product, whether it is Solitaire or whether it is any other product. We could see top allocation if FMCG, financial mainly, insurance. These are high PE sectors. How it is expected to grow and your conviction on this. Senthil, would you like to take this?
Yes. So, sir, first is on the insurance side. I think insurance, so generally we have to look at the embedded value. So the price to embedded value is the metric to value the insurance companies, because the business structure in terms of accounting and everything is completely different. So the PAT for a life insurance company is completely, I could say, it's like irrelevant in terms of valuation. So on a price to embedded value, so the life insurance companies, what we currently have is trades between 1.4 times, 2 times. So they are almost in line with what the growth we can expect on the either be the BNB value growth or the embedded value growth. So second on the FMCG, so FMCG traditionally, if you see, so why FMCG trades at a higher valuation is basically because the kind of stability in terms of right from the P&L level in terms of sales to the margins to the cash flow. And particularly, you have to note that almost most of the FMCGs operate at a negative working capital. So these kind of companies also doesn't take or doesn't need more cash for its business, because the capex will be very minimal. So these are like free cash flow generating businesses. So putting into all these pictures, that's why traditionally FMCG trades at a higher PE than the index. So that's where both these sectors stands, and we always take a call on a 3 year basis. So if you see the some of the key triggers, what is that first is on the urban consumption. So we have seen the last 3 quarters, I think urban consumption has been coming down because of inflation. especially if you see FY25, the steep inflation in vegetables and then fruits and things like that. Plus, we have high inflation in the palm oil, etc. So this inflation-led slowdown in urban was one of the major reasons why the growth was not there. On the other hand, you've seen rural has strongly come up. So for the next year, right, FY26 and 27, so urban could be better because even if you notice the last RBI's expectation on inflation, it has been come down drastically versus the last expectation level. So with lower expected inflation, urban consumption can recover, and one more boost from the government will be the pay commission. So the eighth pay commission is expected by FY27. So that will also boost the domestic consumption. So couple of macro things will boost the growth for the FMCG side. Yeah.
Sure. So one question is on IT sector. Is wait and watch in videos. Do not see any Solitaire stocks, IT stocks in Solitaire so far. What is our view on IT? Is it still wait and watch? And then related to that is high unemployment and will consumption, as most of stocks are dependent in consumption. I'll try to answer both together. And yeah, let's see. So basically, I think what has happened is right. Even today, our view on the IT sector is broadly wait and watch. While valuations have moderated with frontline companies like Infosys and TCS trading around 20-22 times forward earnings, right? Compared to much higher levels earlier. The real challenge is not valuation, but on the growth side. I think if you look at recent earnings reports from top Indian IT companies like Infosys, TCS, Wipro, HCL, Tech Mahindra, all of them are guiding a single-digit revenue growth. In fact, many mid-size IT companies, okay, there have been sequential decline in revenues over the last few quarters. So discretionary tech spending, especially from US clients, remains under pressure. And though the deal wins are still there and these companies are getting few deals, I think project ramp-ups are very slow. And in Solitaire, we focus very heavily on earnings visibility and capital efficiency before buying into any sector or any company. And today, earnings visibility in or for IT is still clouded. And we would prefer to wait and see clear signs of a demand revival or growth coming back. Not just cost cutting, led stabilization, because it's a temporary fix, right? So while valuations have definitely cooled off a little bit, we are not in a rush to deploy capital there yet. If we see consistent pickup in deal execution and growth guidance improving, especially from the US BFSI and retail sectors, which are major clients for Indian IT, we are open to selective participation. But for now, the approach remains slightly cautious and selective. And that's why you don't see IT stocks set in the portfolio. And relating to that, one more question is that IT hiring has severely slowed down, which gave jobs to majority of college students. With AI, will it lead to high unemployment in India? And what impact will it have on consumption? So I think it's a very relevant question. It's true that mass hiring in IT has been slowed down sharply. And with the rise of AI-driven productivity, we may not see the same kind of large-scale recruitment from IT companies that we saw 5 or 10 years ago, right? So this definitely impacts urban employment sentiment, especially freshers, right? But however, when we look at India's consumption story, and Senthil may add to it, we still remain quite confident, and that's because of a few structural factors that go beyond just IT employment, right? I think first, India's consumption base is very broad and diverse. IT services contribute a good portion to India's GDP, but the much larger drivers of consumption are agriculture, manufacturing, services, and government spending also, all of which are continuing to expand steadily. right? And also, if you see recent employment data, there's been strong pickup in manufacturing jobs, especially in sectors like auto ancillary, electronics, construction materials, and to some extent even railways and some other infrastructure-linked industries. For example, we are seeing mobile manufacturing jobs in India have more than doubled in the last 4 years. And this is because of big push through PLI, production-linked incentive schemes, right, to create non-IT employment also. And another point is, I think rural India is seeing a gradual recovery, supported by back-to-back good monsoons, higher agricultural output, and also improving rural incomes. And many companies that are focused on rural consumption, like FMCG or tractor manufacturers, are expected to report better numbers recently compared to the purely urban-focused businesses. And at the same time, on urban consumption also, especially if you look at premium consumption, it looks very strong. Sectors like discretionary spending, be it branded food, travel, hospitality, healthcare, personal finance, all are seeing steady growth, even if mass market demand is a little slower. And finally, I think we have discussed this point many times in the past also. India's demographic dividend is a young working population, which is a huge positive for the next 2 decades at least. Even with changes in hiring patterns or AI coming in, uh, aspiration for better lifestyle, better education, better healthcare, and housing will continue to drive structural consumption demand in India. So while we acknowledge the short-term pressure, which is coming from slower IT hiring, I think India's consumption story is far bigger and deeper, and is being supported by multiple pillars. And I think in Solitaire also, we continue to position our portfolios with strong domestic-oriented companies that are well placed to benefit from long-term consumption growth. So I hope that answers your question. Senthil, if you'd like to add anything, if I've missed anything, please do add.
No, nothing else. I think that is one question on how the portfolio differs for a new investor versus others.
Yeah. So I will just say some portfolios for new investors will not be the same as old investors, and that's the point of having a differentiator or a customized portfolio. We don't follow a model portfolio approach. Someone who started a year back or 2 years back, we would have bought a particular set of businesses in that portfolio. It's not necessary that those same businesses will be there in the new portfolio because of various reasons. Maybe the valuation is not in a comfort zone, or we are not looking to add that business at this price points, or we are waiting for some more clarity. There's always new businesses that are coming into the portfolio for a client who's starting today. Based on today's opportunities and today's scenario and market environment, we are constructing a portfolio. So portfolios tends to differ between clients who are starting at different time periods. Because as I said, yeah, we are very, very value focused and very high focus on risk management. We are not following a model portfolio approach. So portfolio tends to differ for people starting at different time period. Instead of 7% allocation to stocks, 2 to 3% allocation to stocks will reduce the risk much with more stocks in the portfolio. I think we have a diversified portfolio. As Senthil also showed, at the scheme level, we have close to 40 plus stocks. But at an individual client level, we may have close to 30 stocks, maybe 3-4 stocks up or down. And that clearly shows that the allocation cannot be 7%. It's more in line between, as I said, the sweet spot is 3 to 4%. Beyond that, the company needs to scream to us that, please, it's an extremely good buy. And our conviction grows with the valuations and the execution of the management. And then only we go to 5% or maybe 6 or 7%. As we speak, there's only one company in the portfolio which is at 7% plus. Otherwise, our sweet spot is between 3 to 4%. We are not trying to create a concentrated portfolio. We are happy with the diversified portfolio of stocks with a 3% average allocation and let them compound. Yeah, I hope that answers your question. Yeah, question. So there's one more question on telecom companies. Telecom companies are not part of uh, Solitaire since they have debt or based on valuation. So I think yeah, question itself has the answer. Some of the telecom companies are not part of Solitaire because of the high debt levels they have and valuation comfort. So if you look at these balance sheets of major telecom players, right, they carry significant debt, mainly because of spectrum cost and aggressive capital expenditure, right? And Solitaire, as we discussed earlier, we consciously avoid companies with heavy leverage because debt adds to risk, especially when cash flows can be volatile due to competition or regulation. And even though the telecom sector is seeing some pricing power now after years of intense competition, valuations have already factored in a lot of future growth. So from a risk reward perspective for this portfolio, we are not looking at the telecom space. We are looking to prefer businesses with strong cash flows, low leverage, and better visibility on return on capital. And as of today, both on risk management and valuation discipline, Solitaire may not fit our, the telecom sector may not fit our Solitaire framework. Since portfolio is different, each person does all the portfolio outperform Nifty 500. So in our experience in the past, anyone who has been more than 3+ years invested with us, we have tend to outperform Nifty 500 for individual portfolios also. But in the short term, as I said earlier also, that anything less than 3 to 4 years, my suggestion or request will be that try not to compare it with the on the performance because construction itself and delivery will at least take 4 to 5 years. Anyone who is looking to stay invested in this product for a 5+ year period should look at this product. And not this product is not a short-term product; it's a buy and hold strategy meant for long-term compounding, right? Is there any allocation to new age companies? Obviously, yes. We do always track new businesses that are getting listed. But again, as I said, right, that we try to buy businesses which have shown execution capabilities, which have shown some kind of strength. And we are very selective. I think we are trying to look for businesses that have proven business models and at least they have clear profitability paths, good balance sheets. And apart from all of this, they should be available at reasonable valuations. We did took an entry in one of the businesses, new age businesses in the portfolio, because the valuations were extremely attractive, right? And many new age companies are today still in investment mode. Some of them are focusing on growth without showing consistent profits. Well, we are cautious about such models because cash burn and frequent dilution sometimes can hurt shareholder returns over time. But if a new age company is showing real progress, right? For example, cash flows are improving, they are moving towards profitability and they are demonstrating operating leverage, right? And after all that, they are available at attractive risk reward setup. I think we are happy to allocate, and we did get few businesses like this, and we have participated in them in the past. And if in future also, if we get, we will do participate. Our research team is constantly looking out for opportunities, whether it's new age or some old businesses, provided they fit into our filtering criteria and our investment processes. Some small cap mutual funds with 120 stocks and performance is good. So you need to also look at the risk adjusted returns in these portfolios and not just the returns. You need to see how the valuations and the volatility have been in the portfolio and whether it is true to its name. When they say small cap, are all the companies in the portfolio a small cap? And what is the risk of this portfolio? What's the beta of this portfolio? Because at Solitaire, we are not trying to just focus on returns. We are trying to deliver superior long-term risk-adjusted returns. And if we stick to our process and stick to our discipline, I think we are confident to delivering that. Obviously, it totally depends upon each individual what type of risk they want to take with their investments, and we are going to stick to our risk management philosophy, and we are not going to step outside just to deliver or aggressive just to capture extra returns. Our focus is on risk-adjusted returns. And sometimes, when you have too many stocks, the portfolio often starts behaving like an index. And over a longer period of time, it becomes harder to outperform. Solitaire's goal is to build a portfolio that is different, high conviction, and capable of delivering, as I said, superior risk-adjusted returns, and not just to track or match the broader market. So maybe 120 stock portfolio have done well during a broad-based rally. We believe our focused and quality-first approach will stand out better across full market cycles, both good and bad.
I think there are no questions, I think.
Okay, great. So I think thank you so much for joining in and spending a Saturday morning with us and patiently listening. We will be happy to answer any questions. You can reach out to us on our website or LinkedIn channels, and we'll be happy to connect and discuss a little bit more in detail. Here are the contact details also. Thank you so much for joining in, and appreciate your questions and your feedback. Thank you so much.
Yeah, thank you, everyone.